Well, hello everyone, and welcome to Alternative Design's presentation of the April product launch. I'm Tim Harding, Chief Marketing Officer for Alternative Design, and I think we've got some really good stuff this month. A few minor changes, but for the most part, all for the good. We're going to have 5 basic products on our platform this month, and I think you're going to like what we have to share with you today. New product coming online. I kind of teased about it last week on last week's webinar, and so for those of you who weren't there, you missed the preview, but you'll get the full thing today, and I'll be pleased to talk about the JP Morgan product that we are featuring here in the month of April. As always, if you have questions on any topic related to the MarketLink CDs, please go ahead and type your questions into the chat box on your control panel. And I will, as usual, respond to all of the questions at the end of the presentation here. So as questions occur to you about the products or anything else for that matter, please go ahead and put those into the chat box, and I will respond to those at the end. So with that said, let's just jump right into the products and get down to business here. As I mentioned, we have 5 products on our platform this month. We have a couple of familiar ones. We have the Bank of the West Commodities Income Advantage product and the Bank of the West Equities Income Advantage product. Both of those are very, very popular. I'll review them as we go through the presentation today, but they're among the simplest products to explain and present to qualified prospects and your clients. We have the Goldman Sachs 8-year product. Available again, but with an enhanced cap, a little bit higher cap rate on that one. Then we have, of course, the very popular Bank of the West Morningstar Ultimate Stock Pickers Index linked CD. That one's very popular, one of my favorites. And the new one that we'll be introducing this month from JP Morgan is a 7-year product linked to a high-yield bond index. And so the first time we really have bonds in the mix here, it'll give us the opportunity to actually do some asset allocation planning and some portfolio design for our clients, all within the confines of a principal protected and guaranteed group of instruments that have the added security of FDIC insurance. Commissions have been bumped in some cases. You'll see the Bank of the West commodities product is now at 2.5%, as is the Goldman Sachs. That's actually down a little bit on the Goldman Sachs, but increases in the others. 2.5%, that's a bump up in the equity income advantage. 2%. On the JP Morgan High Yield Bond Fund, and a bump up on the Bank of the West Morningstar Ultimate Stock Pickers Index to 2% as well. So pretty good compensation this month. Hope to keep it there, and with your volume coming in, we're able to negotiate better and better deals with the banks, and really it all comes down to how much principal, how much premium can we give to them. And the more we give to them, the more leverage we have, and the higher payouts we can negotiate with them. So thank you for your business. You're doing a marvelous job out there in the field, and that's enabling us to get some better deals from the banks, and therefore some better deals for you. On the commodities-linked CD front this month, once again, we only have one. It is the Bank of the West Income Advantage product. It is, of course, a 7-year product. Has a minimum guarantee this month of 1% and a maximum interest payment of 7%, down just a little bit from the previous month on the maximum, but still a 7% return on a CD is pretty good. Linked to the same 5 commodity sub-indices that it has been for the last couple of months. We're still hanging in there with cocoa, coffee, corn, lead, and natural gas. So what this particular CD does is it tracks the performance of each of those 5 sub-indices of the S&P GSCI Commodities Index. And on the calculation date, or what we would normally in the insurance industry call the anniversary date, if all of those stocks are equal to or greater than their initial share price, the client will automatically receive the maximum payout of 7%. If one or more of those stocks is negative on the calculation date, the client would get the alternative guaranteed minimum of 1%. So, this is like you call it an either-or product. There's nothing in between. If none of the stocks is negative, the client gets the big number. If one or more of the stocks, or commodities in this case, is negative, the client receives the smaller number. In this case, 1%. So this is the only commodities-linked product that we're offering this month. Most of you who follow the markets know commodities have been down pretty dramatically over the past year. This just might be the opportunity to take a position there. There's talk out on the street now that the market may be a little bit overpriced. I mean, we just set a new record in the market. How long is it going to last? You might want to hedge your bets a little bit by getting into commodities while the prices have been beaten down, and take advantage of that inverse correlation that commodities have to stocks. It's an opportunity you probably need to discuss with your clients. So one commodities-linked product this month, the Bank of the West Income Advantage. On the equity side, we've got a same type of product. Looking at you, another Bank of the West product, also a 7-year product, also called the Income Advantage. Minimum guarantee of 1%, just like the commodities, and a 7% maximum, just like the commodities linked. So these are two very, very similar looking products this month. Mechanics and structure is all the same, and the minimums and the maximums are also the same in these products. So very easy presentation to make. The stocks that the equity-linked product is tied to are a little bit different, but these are all companies that we've seen before: Apple, AT&T, ConocoPhillips, L'Oreal, and PPL Corp. We've seen these before, just a little bit different mixture from last month. And once again, this is an either-or product. If all of those stocks are equal to or greater than their initial share price, on the calculation date, the client will receive the 7% payout. If one or more of those stocks is negative, then the client receives the minimum guaranteed annual amount of 1%. So nothing in between. It's either the 7% or the 1%, depending upon the performance of those 5 stocks. So very simple products to explain. And, I always like to point out that because these products are so similar, and because there is this inverse correlation between stocks and commodities, pairing the 2 income advantage products together, one in commodities, one in equities, might be a great way to have a interestingly balanced portfolio, because as one goes down and earns the minimum, it would increase the likelihood, there would be an increased likelihood that the other one would go up because of that inverse correlation that I talk about all the time. So just a thought. I think they make a great pair together, easy to understand, easy to explain, and have the potential for, over the duration of the CD, to put up some pretty nice returns. You only have to hit that maximum once or twice for this to be a significantly well-performing CD compared to traditional CDs. The other equity-based product that we've had, it's our 8-year product from Goldman Sachs. A little bit higher cap this month. Last month, I believe it was 5 1/4. This month, the minimum cap will be 6.125. Possibly even a little bit higher, but at least 6.125 auto cap. And, the highest minimum guarantee out there at 1.5%. This product is linked to a basket of 10 stocks. These are the same 10 stocks again this month that we've had in, I think, the previous 2 months. You've got Apple, AbbVie, Caterpillar, Cisco Systems, McDonald's, Merck, Microsoft, Occidental Petroleum, Walgreens, and Walmart. So again, the traders at the trading desk at the Goldman Sachs are pretty confident in this particular basket of stocks because they keep repeating it. So no big changes here, with the exception of the compensation coming down 25 basis points and the cap going up. I do want to stop and talk just a little bit about the auto cap calculation because it is somewhat unique and new to some of you who have only joined us recently. The way the auto cap works is this. On the calculation date, or what we would typically call the anniversary date, the bank compares the initial share price to the current share price and measures the difference. If the share price difference is negative, then we're going to credit the average to that negative, but no lower than the floor. This has a minus 15 floor. If the share price is not negative, in other words, if it's equal to or greater than its initial share price, then the client's automatically credited with the cap for that stock. And then we're going to take all of those calculations, the caps and the negatives down to the floor, add them all up and divide by the number of stocks in the basket, which is 10. And that average will be the interest rate paid to the client. So on this product, the client would get the greater of that average or the 1.5% minimum guaranteed. So you're looking at a product here where you have principal protection and guarantees, FDIC insurance, and will pay no less than 1.5% on an annual basis, up to a maximum potential return of just over 6%. So all in all, a very attractive product and reasonable compensation of 2.5%. We have a couple of index-linked CDs this month. And those of you who've heard me talk about the indexing strategies utilized by the banks with proprietary indices will remember that these are always an index with a plan. The S&P 500, which we're all familiar with, is really a passive type of index. Not a whole lot going on there. It's just driven by the market. If you're linked to the S&P 500, you're just like being in a raft going down a river wherever the current takes you, because that's what that index is going to do. The proprietary indices that banks often use implement strategies and are very frequently dynamic, meaning they change. So you're not pulled down the river. You've got an index that is alive and ever-changing, but reflects a broader marketplace. Of course, the one that we've had for a while, which is very popular, is a Bank of the West product linked to the Morningstar Ultimate Stock Pickers Index. It is a 6.5-year point-to-point product, which means there is no annual interest rate paid on this product. It's just like the old FIAs back in the day. You have a beginning point and an ending point 6.5 years out. At the end of the term, the bank is going to measure the difference and pay back the principal and pay back that interest based on at least a 115% participation rate. It could be even higher with no cap. And of course, this is all linked to the Morningstar Ultimate Stock Pickers Volatility Controlled 7% Index. Now, if this is your first time, what is the Morningstar Ultimate Stock Pickers Index in the first place? Well, Morningstar, who's in the business of evaluating the performance of portfolio managers, I mean, they rate mutual funds and ETFs and now even individual stocks. Morningstar is in the business of evaluating and grading how well a portfolio is managed. And what they have done is they have chosen who they believe to be the top 26 managers of money in the United States, the best of the best, the ultimate stock pickers. And then they've created an index that mirrors the choices that those money managers have made in the portfolios that they manage. So basically what you have is an index that reflects what the best of the best do in terms of money management. And Morningstar doesn't stop there. Since these money managers change their portfolios in reaction to economic conditions and anticipation of changes and trends, the index changes too. So it is a dynamic index. Every 30 days, Morningstar rebalances based on what the top 26 money managers in the country are doing. Now, it has a volatility control on it of 7%, so you're not going to see big swings and you're not going to get full market return, but it is principal protected and guaranteed, and it does have FDIC insurance. And even though you're not going to get the full upside of a market, you're never going to capture the index, and it does pretty well. Calendar year 2013, the return on this index was 15.54%, over 15.5% in a CD. In a CD. Not a bad return at all. And if you just take a rolling 12 months, the past 12 months, the index is up 8.12%. So you've got the potential for, mutual fund type of returns in a dynamic index that is a principal protected FDIC insured product. One of our most popular, and I think one of the most exciting ones to explain, I mean, this product has a lot of sizzle. And we all know that you need a little sizzle if you're going to get in front of qualified prospects and clients. Now, just as an example of some of the money managers that Morningstar has chosen, you'll see some familiar names in here. Oppenheimer is in here. Vanguard is in here. Oh yeah, Berkshire Hathaway is in here. Hartford is in here. Wouldn't be the ultimate stock pickers if Warren Buffett wasn't showing up in there. So you've got some of the top names in money management in the United States basically guiding this portfolio. So you've got a really, really unique product here. You'll recognize, most of the holdings that these big money managers choose: Microsoft, Walgreens, Coca-Cola, 3M, IBM, Costco. I mean, you're going to see a lot of big names in here, and not coincidentally, you're going to see a lot of the same names that you would find in the stock baskets of some of the other bank market-linked CDs as well. So all in all, I think this is a very, very interesting offering. They pulled it off the market for a couple of months last year, but by popular demand, it's back, and I hope it stays here. The disadvantage to it, of course, is that it doesn't pay annual interest, and so your client has to sit out and wait, until that 6.5-year period passes to capture a gain. Doesn't have annual reset. It's pure point to point. But if you think about it, that's really no different than investing in a mutual fund that you're going to sell in 6.5 years. If you could invest in a mutual fund managed by the top money managers in the U.S. and you were guaranteed a return of your principal in 6.5 years plus any gains that they managed to earn over that period of time, would you invest? I know lots of people who would, and yet you have a product here that basically does that with the added security of that FDIC insured wrapper on it. So all in all, I think this is one of the best indices that I've ever looked at, and I think it's a fabulous product especially for qualified money, for somebody who doesn't need to capture the interest every year. Okay, and now for the new kid on the block from our good friends at JP Morgan Chase. It is a 7-year variable income CD, a minimum annual guarantee of 1% paid annually, linked to the JP Morgan High Yield ETF Volatility Index. Basically, this is an index that has no cap and reflects what the good people at PIMCO are doing in terms of their ETF. Annual interest is linked to the performance of the JP Morgan High Yield ETF 3% Volatility Target Index, which is based on the PIMCO 0 to 5-year High Yield Corporate Bond ETF. And so you've got some big players in the bond market involved in this particular index. We won't spend a lot of time talking about PIMCO. Everybody knows of them. But I think the timing on this product coming out is really, really good because what we're seeing in the financial press is that more and more money is gravitating to the high yield bond area. And here you've got a product where You've got volatility controls on it. These are short-term interests, so you're mitigating the interest rate risk that longer-term bonds have. You're getting a higher yield because these are high-yield bonds. These are instruments issued by companies that don't have the top creditworthiness in the United States and therefore must pay more to be capitalized through bond offerings. And so you've got an opportunity here for your clients to be involved in the high-yield bond market without a lot of the risks that are typically associated with that. Since this is an index based on the performance of an ETF, your client isn't directly exposed to the bonds themselves, and it allows the people who manage the index at J.P. Morgan to adjust their exposure to that ETF to control the volatility. And so there are a lot of good things about this product that I really, really like. When I package it into a presentation like this where I've got 4 other products to review, I can't really do it justice as the new kid on the block. So to find out more about the J.P. Morgan High Yield Bond product that we have just put on our platform, come back next week. Same time, same place, 11:35 Pacific time. And I will dedicate that entire webinar to taking the J.P. Morgan High Yield Bond product apart. Has a little bit of a different crediting methodology than you might have seen before. Really fairly easy to comprehend once you take a close look at it, but a little bit different, and some different characteristics. And of course, there are always questions and issues about, well, gee whiz, is this the right time to get into high-yield bonds? Interest rates might very well be going up soon. When interest rates go up, don't bonds go down? Yeah, there's all kinds of questions like that, and we will handle all of those next week in great detail, because this is a really well-positioned product. They know what they're doing. It is the structure of this particular CD is very, very good in my mind. And yes, it does address all of those issues about what happens in a rising interest rate environment. Keep in mind, just a brief answer to that, these are all short-term bonds, 0 to 5 years. The average duration in these bonds right now in that particular index is less than 3 years. And since the index doesn't own the bonds, they can reposition the index rather quickly. So this, I believe, is going to be a very steady producer, but it also gives you an opportunity that you maybe never had before. I mean, think about this. With market-linked CDs linked to stocks, commodities, and now bonds, you've got an opportunity to really do some asset allocation and some portfolio design for your clients in a unique FDIC-insured environment. I mean, if you start thinking about this, you have to start scratching your head and going, why would anybody invest any differently? Why wouldn't they choose vehicles where they're not going to lose their principal, where they're FDIC insured, and yet they can gain exposure to different asset classes and change those as necessary as the CDs mature with their situations in life. So an opportunity to do some serious planning here, but within a very, very safe environment. So with that, I know I've run through these rather quickly, but we're coming up on our 30-minute mark here. So at this point, I will pause and respond to as many questions as I can. If you have a question and you haven't put it into the chat box yet, please feel free to go ahead and type those in, and I will respond to as many of them as I possibly can. A question here from Rick. I'm not sure on which particular CD this was directed, but actually the answer applies to all of them. His question is, does the return compound? And the answer, Rick, is no, it does not compound. The interest is paid out into a money market account and then needs to be reinvested. It is not automatically compounded inside the CD. The short explanation is that these CDs have about a 3-week offering period. Once they close it, no more money, including interest money, can go into that CD. Everything is locked down at that point. So the interest is paid outside of the CD into a money market account with the custodian. You're notified of that as the agent prior to the client knowing about it. A great time to schedule an annual review. They're about to get a check. And they need to decide what to do with the money. So, we found very often there's a bigger sale the second time around than the first one. So good question, but no, the interest does not compound. Let's see here. Question from Raymond. I'm not sure I can completely answer, Raymond. This is what happened to all the quantitative easing money the government put out. Where did it go? Who received the money? Banks, investment firms, etc. I'm not an economist, Ray. I can't give you an answer to that. I can only give you an opinion, but I do know that a great deal of that money was used to purchase U.S. Treasuries in an effort, a successful effort, I might say, to keep interest rates very, very low. And what the concern is if that quantitative easing backs off, if the government buys fewer bonds, then interest rates are going to start going up. And so that's the best answer I can give you. Let's see. Dave asks, what does the cost look like for the client? Dave, these are held at par value. There is a market value fluctuation if the client were to liquidate the CD prior to maturity, but there are no direct costs to the client. They put $100,000 into CDs. They have $100,000 at work for them at all times. There is a nominal fee from the custodian. There's no charge for the first year, but thereafter there's a $50 a year fee taken out of the interest to cover the cost of the custodial account. That is significantly lower than any other custodial accounts that I've seen, including custodial brokerage accounts. So that would be the only cost to the client would be that $50 a year fee starting in the second year. Rick asks another good question. Can the money which goes into the outside money market fund be accessed before the CD matures? And the answer to that, Rick, is absolutely yes. That money is sitting in the money market fund waiting for the client's direction as to what to do with it. If they want it to be invested in additional CDs, that can happen. If they want the money paid to them because they have other plans, that can be done as well. Okay, Ray has a question here. U.S. Bank investment broker-dealer today told MLCDs some only return gains by year 6. Is this accurate? And Raymond, I'd be happy to have that discussion with you. I'm not really sure what he's claiming here. Clearly, the Morningstar product, you don't capture interest until the maturity date. So that would be an accurate statement on that product. It doesn't pay annual interest. It only pays on maturity. So you could accurately say that you don't get any return on that product until 6.5 years from now, and that would be accurate. That would be true. But we have a number of others on the platform that do pay annual interest, as you've just heard. So I'll be happy to discuss with you what he was saying and see if we can clarify that. But not quite sure I really understand what he was trying to articulate. You could also say that, hey, some market-linked CDs have a maturity as long as 20 years, and that would be true too. But you won't ever see any of those on our platform because those are for institutional investors, not for your typical consumers. So, it looks like that is it for the questions. I want to thank you once again for taking your time to spend with me today. I think we've got great product offerings this month. Look forward to a terrific April. April's CD rollover month. So with that, I wish you all a great week, and I'll be back here talking about the high-yield bond CD, linked CD, next week, Wednesday, 11:35 Pacific time. Thanks for joining us. Have a great week.